Okay, so if no one has their mic on or you're not talking over that topic, just kind of keep your mic off just because we were picking up some background noise earlier. But I'm going to mute everyone just for a second, or if y'all will just give me 2 minutes, we'll start our first topic. And then Fake Pear Bear is going to record. So we will start right now. Everyone, my name's Erin. Today is the second night hosting our Investing for Beginners space. We're trying to keep it a lot shorter this time so that we get exactly 1.5 hours of audio for Fake Pear Bear to record. And then we're going to post it to my YouTube channel at a later date. So that YouTube channel is going to be called The Blonde Broker. That's actually my new name. Tonight's going to be the last night having my username as Erin Talks Stocks. I think I just like The Blonde Broker better, and I'm keeping my name out of everything. So yeah, the reason for doing these spaces, as y'all know so far, is to give back to the community with any advice that we have. We know that it's very intimidating to jump into anything without having the proper background. I'm an electrical engineer, so I didn't have any trading experience prior to 2019 when I started, and I'm still learning something new every single day. I love trading, and I want people to enjoy it just as much as I do. And there's just a lot of value in learning from others. These spaces have been a blessing, being able to connect with everyone. And I just wanted to thank the speakers for allocating some of their time to be here. And I appreciate it so much. Last week's space was absolutely amazing. So let's keep it rolling and start with topic number 1. I think we should follow up with due diligence, since this is where we ended last week, and this is one of the most topics that we get asked about. So I'll let Alex take it away.
Well, I appreciate it, but there are many other people that can definitely go through due diligence. But like we said from last week, with due diligence, there are a lot of resources that you're going to have as a beginning trader. You're going to have to learn about it. One of the biggest ones, the most important ones, is knowing the resource to go. You got to go straight to the company itself for investor presentations, but as well as where they are filing certain filings from. And you go to sec.gov and go to their Edgar system, and you go through from their 8Ks to their 10Ks, 10Qs, you name it. You go through there, and everything from prospectuses to financials to what the company is doing every day and every quarter, it's all there. The story is there. So if you're going to want to get it straight from their mouths, that's the place to do it. Also, for due diligence, I do believe that chart analysis is due diligence as well. You need to know where they're currently positioned. If it's a good time for you to enter, it's kind of hand in hand with how the company is doing overall, value-wise. If they are looking a little bit overextended, finding a good entry point there. That's really a lot of it. And then you look over the company itself, and you break it down to categories from number 1, what's the company? What's their sector? What's the overall growth rate per year? Because it'll show if it has a high growth rate, that means that it's going to be growing substantially. You could get a good return of investment potentially. Then you look over the company's infrastructure. You look, how are they built out? Do they have multiple factories? Are they global? Are they only centralized in a certain location? So on and so forth, to see if they are pre-revenue or are they generating revenue for a long period of time. Because literally with pre-revenue companies, if they don't have the infrastructure built out already, you're going to be sitting there for a while waiting for them to generate any kind of income or revenue and actually build up on their value. So that's a lot of the issues we see with SPACs and a lot of startups. That's the biggest issue. It takes a little bit for them to start generating revenue. And then after that, you look at their leadership. You make sure that they're credible, that you don't have any toxic type of leadership in that area. And then I liked at the end of it is disruptive and innovative. You need to look at the company and see what makes this company different. Can they replace the ones that are currently taking advantage, like are the top dog in that sector? Or if there's nothing special about it, then why would they go to that company of the startup over the likes of the top dog? You always need to look at what makes this company special, what makes them different, and makes them disruptive. That's a lot of it. And I know that Special went over it last time we talked, and he did a very good in-depth analysis on the SEC.gov filings, and I appreciate it. That's it for me.
Thanks. Taking a step back, instead of repeating the public document analysis discussion we had last week, one thing that I like to do, and actually, William Danoff of the Fidelity Freedom Funds sat me down when I was at a conference in school many years ago to kind of share how he thought about it. And the first thing you need to do when you look at a company is tell yourself, how does this company make money? Very simple, okay? Is it a subscription model? Is it a retailer? Is it a supplier? What are the end markets? If it's a bank, what type of bank is it? Is it a money center bank? Is it an investment bank? Are its revenues coming as fees? Is it taking principal risk? Is it lending money at a long-term higher rate, taking advantage of the yield curve and borrowing in the short-term market? If it's a real estate company, what type of real estate company is it? Is it an equity REIT? Is it a commercial REIT? Is it a residential REIT? Is it a hospitality REIT? I mean, you can go on and on and on. And, taking it full circle, the most important thing for you to do is to go into the public filings and determine who are the nearest competitors, write a micro industry, companies in the SaaS space serving XYZ customers. Find the 4 companies that fit the definition, write what the industry is, and then evaluate, okay, do I think this is a good business? And then look at the valuation. So understand how the business makes money. I can tell you that 90% of my subscribers at specialistresearch.com, 90% of the people that DM me ask me about companies, and I say, okay, why don't you tell me first? What do you think about this company? How does this company make money? And for a lot of the time, they can't really tell me.
Yeah. So, that's it on DD. We can go ahead and talk about the next topic. I wanted to know what the difference between fundamental analysis and technical analysis was in y'all's eyes. I think we get a lot of those questions on, whether we're looking at reports, catalyst, knowing what's ahead for the company versus, past trading activity. So if anyone wants to pick up those 2 topics, that would be awesome.
So the easiest way, there are a lot of free resources on the internet. I think for someone that wants to take this and do their own research, I would look up the efficient market hypothesis, weak form, strong form, and just do a lot of reading, and it'll become apparent right away. But I'll try to summarize. Historical data, historical price charts, historical volume relationships, historical implied volatility data. That is usually technicals, patterns that you can see in stock price. More sophisticated algorithms where you essentially look at price, momentum, volatility, and make a decision based on that. Looking at historical holdings, 13 Fs. Looking at historical filings, fund flows. That is technical analysis. Where is the money going? What is the price action? What is the price people are paying to get involved? When you look at implied volatility. And my background is more fundamental, so I'll speak to fundamental. Fundamental encompasses a lot of different things, right? People describe it in many different ways. In my opinion, it is identifying, is this a good business? Does it have a moat? Is it sustainable? Identifying what the risks are, identifying the quality of the management team, identifying where it falls in the competitive landscape and it's in its respective supply chain, identifying whether it's in a good industry or bad industry, doing work to figure out its growth path, doing work on its customers and suppliers. That all encompasses fundamental analysis. And when people talk about fundamental analysis, they ignore all that and they just talk about valuation. They say, well, is this a 5 PE or a 10 PE? But none of those numbers really matter until you put them in context, right? A 20 PE might look expensive, when someone throws a number out. But if a company's growing earnings at 15-20% a year, then it's not expensive. A 5 times revenue might sound expensive, but if the company's growing its revenue by 40% a year, it's not expensive. So it's really important to put things in perspective. And when people talk about fundamental analysis, when they're talking about multiples, just take a step back and realize that they may not be sharing the whole picture with you, or they might not know what they're talking about. Fundamental analysis is thinking about a business like you own the business and making a decision on whether you want to own that business in the future.
And I want to kind of add on to that. That was perfect for covering both fundamental and technical. To put it in perspective as you, the investor and the trader, you have to look at it that both ways. You should learn both styles, fundamental and technical. I think that you need to be able to learn both to be a very successful investor and trader. But when it comes down to it, you need to look at yourself in the mirror and see, are you a long-term investor? Are you a swing trader? Are you a day trader? Because technically, a lot of day traders and swing traders, they go off of the technical. They look at the company overall. They look at the performance that they've been going for the last month or so, overall 3 months. Look at the positioning, and then they, depending on the chart analysis and results from earnings reports, you name it, they'll enter, and then they'll just swing trade it, and they'll find ways to enter and get out. Long-term investors are a lot of the fundamentals. I like to kind of have a good mixture of it, especially when you're looking at a company potentially in long-term investing for the future, and you believe in them. You only believe in them because you do that due diligence upon looking at the company as a whole. I believe that's what you, like you said, you're a fundamental investor. That's what you were when at your previous job.
Yeah, that's right. I was a fundamental investor that looked at companies, but also used legal arbitrage, looking at companies emerging from bankruptcy, doing merger arbitrage, convertible arbitrage, taking advantage of legal documents, and also fundamental values.
Yeah, but you predominantly with your you worked at basically like a brokerage, and you did long-term investments predominantly, and you believed into the company overall fundamentally that they would grow, and over time they would grow. You guys would scalp a little of your positions until the point where you were comfortable enough to take your full position out.
Yeah, so there are various things that we did. So I worked at Goldman Sachs Asset Management. I wasn't a broker because I wasn't licensed. So I was working on the asset management side for many years. We did banking before that. And we would take positions from, 2 weeks to 6 weeks. There's a dual class share arbitrage. We would look at 3 months to 6 months trades for merger arbitrage. We would look at, for spin-offs, we might only be involved for, a couple of days, spin-offs, split-offs, MLP, reconversions. We also had long value positions. Now, when we believed a company was 20, 30, 40% cheap, to intrinsic value or to peers, and it was going through a transformation. And we would also take 2 to 3 year bets where we would do 1, 2, 3 months of deep research and take, a $200 million position. We also had much smaller positions, $1-2 million positions, where we would also do trading based on, our views on earnings. So there's a plethora of different things, but all of them were kind of rooted in fundamental analysis. For the bigger trades, we went very deep. For the smaller trades, we looked at maybe 2 or 3 different factors.
That's exactly what I think about it. If you're doing those short-term trades, you focus on predominantly the technical analysis, find your entry point, look at all the indicators, look at all of the chart analysis patterns, and then you find your entry point, and then you go for that short-term swing. Fundamentals, long-term investments. That's what I believe, and I think that's awesome to hear.
Yeah, I completely agree with that. Thank you, guys. That was actually a really great explanation. With that, I was hoping we could talk about RSI. So what is an RSI, and how does that affect the stock, which way it moves? Would anyone want to cover that? Oh, I see Krang just requested down there.
I think just a pretty simple commentary on RSIs is just an indicator of influx strength. And so generally speaking, above a 70 is an overbought RSI, and below authority, a 30 is an underbought RSI. For beginners, that's a good place to start. But I mean, that's just the basic definition of how to view an RSI and how to view it stands for relative strength index, for anybody who's wondering.
And to kind of add on to that is that relative strength indexes are used predominantly in a multiple ways. You just need to look at when it comes to technical analysis. This is predominantly for technical, clearly. Day traders can see when it's overbought, it's going to be overextended. If anything above 70, like Stock Talk Weekly said, most likely when it has reached that point, that's overextension. And if it goes to like 80, 85, that's its peak. It will pull back at that point. And usually anything around 50 to 40 is a healthy entry point. But if it dips below and starts to reach the 30 point, that's showing that it's going to be oversold, and it's going to be point of where it's going to start dipping more. Or if you're waiting for a position for like a day trading, that could give you a good entry point. If it hits 30 or below, that could provide a decent entry point. But it's very basic, and that's just one indicator. There's a lot of other indicators that you need to look at to help you find that entry point. So RSI is just one of a plethora of indicators to help you day trade as well as swing trade.
Yeah, and on that point as well, like I think people should understand, again, I'm trying to speak from a beginner's perspective in this space just to appeal to the people that are here from that reason. But when it comes to RSI or any other technical indicator, as Alex said, over 70 is considered by the book overbought, but you will see equities very often that will keep running hot with an 85 plus, sometimes 90 plus RSI that can run hot for months. So don't take it with a grain of salt when you see an RSI indicating that the stock is overbought, because if the volume influx and the buy side pressure stays high enough, those stocks can run hot for, I've seen at times stocks run, keep running 5 or 6% a day in a hot market on a 90 plus RSI. And, people are putting in short positions, assuming that it's a definitive indicator, but nothing is a definitive indicator. Not RSI, not, MACD, not support line trends, not levels. Nothing is definitive. It's just all of technical analysis. And this is not me discounting technical analysis or saying that it's not important, because I think if you don't know how to read a chart, I said this on my spaces earlier today as well. If you don't know how to read charts and you don't know the basics of technical analysis, then you will not find ideal entries over the course of your trading career. You will not find ideal exits over the course of your trading career. And the difference in profits that you can make from having a sophisticated understanding of technical analysis will blow your mind. Just the 5 to 6% difference in profits on those trades can really make a difference over the extended period of time. So don't take any indicator literally. Don't be guided by a single indicator. I know a lot of new traders who, realize what RSI is, or, learn about MACDs or learn about these things. They get so hyper focused on letting that dictate their trading strategy. And I highly, highly, highly advise you not to do that, and to find at least a basket of indicators that can guide your trading plan. Because at the end of the day, it's just information. It's just data points. And the more data points you have, the better your decision-making will be. So I think that's something simple to put.
Yeah. Okay. So essentially, the RSI measures the speed and change of price movements, and just kind of lets us know when something's overbought, when we would need to sell, or oversold when we need to buy. So that was just
essentially, yeah.
Yeah. So it's just my simplification. Yeah, do y'all, I think we should move on to price volume analysis. I know we talked a little bit about this last week, but this was kind of a larger topic that most new traders have trouble understanding.
Sorry, what was the topic? I missed that.
Just price volume analysis.
I guess they're referring to just volume analysis mainly, but
yeah.
There's different ways to associate price action with volume. I'm a very volume focused trader. Now, when it comes to like my long term stocks, I don't really care about the volume patterns necessarily. Obviously, if there's like a severe drop off or something, I'll try to see what's up. But just purely from a trading perspective, depending on where you find your data, you can usually find a variety of data points. You can find 1 year average volume, 6 month average volume, 3 month average volume, down to 1 week average volume. And then obviously, your brokers, any decent broker will show you the daily volume. So when you compare these different metrics over time, historical volume trends is the, I guess, fancy word. But when you look at these historical volume trends, you can compare like how sentiment has changed towards a stock. So, I guess like a simple example is if you see a stock with like an average 3 month volume of 400,000 and then one day randomly the volume is 15 million, well, you probably have something happening then in that name, whether it be a press release or, a just drastic change in sentiment, a short squeeze, any number of things. But the point is that volume precedes price action generally. So a lot of people think like, oh, the stock's up 4% and, there's a 10x volume surge. I miss my opportunity to play this game. Well, not necessarily, because very often what you'll find is that the day that you see that massive volume influx is actually the precedent day. And so the next day or the day after or the week after, you might see that chain effect of the price action. Because a lot of times what it is it'll be, a large buyer buying up and locking up a massive amount of the float. And in that case, the effective available float, now it becomes less. And so when you see people chase that trend, you might get, rapid price action following a volume influx. So, there's a variety of ways to look at it. It's not one way every time, but I'm a huge proponent of studying volume and paying attention to volume. No good setup works without the right volume. So I don't know what the question was necessarily specifically, but just with regard to volume analysis, that's like a couple good points for beginners.
So I also look at volume. Something very simple you can use is if you're looking at 3 month average volume, is how big you can get into a stock, how easily you can buy and sell. If you're gonna have a larger position in a name, if that name is only trading 10,000 shares a day and you want to build a 5,000 share position, it's probably not going to happen in a day. And if you are day trading or swing trading and you're not looking at it from a long-term perspective, you might want to avoid that name completely because you're not going to be able to get out if you want to. So a rule of thumb that they use at funds is not to be more than 10% of the volume of any name that you trade. And that may not be an issue for a number of the people when you're looking at large cap stocks, but when you're looking at smaller cap stocks, you would be surprised how often some of the names actually trade that are not a focus of FinTwit or Reddit.
I think that just on that point, what Special is saying, Special is essentially saying is that you're not guaranteed liquidity on some of these smaller names, especially when they're low volume trading. So I think that people assume that because there's market makers that you're going to have infinite liquidity on every ticker. That's not the case at all. So yeah, please pay attention to that. That's a good point to make about just being sure that the tradable float, or not even the tradable float, but the actively traded float is comparable to the size of the position you're trying to take, and also knowing that when you're trying to exit that position that you can easily dump those shares into that actively traded float without any issues. So yeah, good point.
Okay, so I wanted to talk about preferred stock versus common stock. I'll go ahead and give my definition. If anyone has anything to add on, you can. But this is just kind of simpler terms. The main difference is that preferred stocks, they give no voting rights to the shareholders, while a common stock does. And the preferred shareholders have priority over a company's income, meaning that they are paid dividends before common shareholders. So a lot of people ask when they are investing in a stock what a dividend means and how they're getting money back. So if y'all have any examples of that, that'd be great for the beginners.
Yeah, sure. I had a very large portfolio of preferred stock during the pandemic crisis that we saw. And the reason why I bought bonds and preferred stock before I bought common stocks was there was uncertainty. And I realized that for a number of these names, when you think about a company, you need to think about what are the sources of capital that are creating and funding that company. So when you look at Apple, Apple is not just Apple stock, right? Apple has bonds, Apple has convertibles, Apple has revolving credit facility. In this case, it's unsecured, but it could be secured. Now, what that means is companies have various sources of capital to fund themselves. Stocks exist because companies use the money they raise from an IPO to invest, right? They do things, they allocate that capital. So the higher you get up in the capital structure, and actually I used to teach this course at Northeastern, the higher you get up in a company's capital structure, the more secure you are. So at the top of a company's capital structure, you have a loan. It's called a revolver. That revolver is like a credit card for a company. Companies use that money to buy things, to buy inventory. That usually has a low risk because it's secured, but it also has a low return. It has a low coupon. Below that, you have a bond. You probably hear about bonds on CNBC. Your parents, your friends, even you potentially own bond funds. Bond funds, usually have lower coupons or lower dividends or income that you can get from them. But they're very secure in that if a company's stock falls 50, 60, 70%, usually the bonds are unimpaired. And that depends on the asset quality of the business. It depends on the underlying ability for it to pay interest. But I'll get into that in a later session. Below the bonds, you have equity-like securities, convertibles, and preferred. Convertibles are just bonds with warrants or stocks attached. Okay, so they have bond and stock-like attributes. And preferreds, which is the focus of this question, are a very interesting asset class because they tend to be very illiquid. So it's hard to get huge size in preferreds. So from a technical perspective, you should know that. So they're more for long-term holds. The second thing you should know is that, like Aaron said, preferreds don't have voting rights. So when you're a common shareholder, if a company has a proxy, right, like AMC is having a proxy on July 29th, potentially, where you can vote on specific things like increasing share count, board members, etc. As a preferred holder, you don't get to vote. Okay. The benefit of having preferred is it usually pays a higher dividend than the common, and that dividend supersedes the common dividend. So if the company can stop the common dividend and still pay the preferred dividend, but more importantly, there's something called a cumulative dividend. So if a company just runs out of cash like it did in the pandemic, a lot of REITs did, and they decide not to pay dividends, a cumulative dividend, if the company starts paying dividends 3 years from now, it has to pay all the dividends it missed over the past 3 years, which is very powerful, right? So you can buy a preferred sometimes, like I was buying preferreds at 10, and they had like a year's worth of back dividends. So I was actually buying something at 10 that was worth 27. So most preferreds, so bonds are usually issued in 1,000. Preferreds are usually issued, retail preferreds are usually issued in 25s or 100s. So a par, or like the full value of the preferred, is usually 25. And if you can buy it at a discount to 25, you can actually earn a yield higher than its stated coupon. So the coupon is the rate that it's paying you. Sometimes they pay you quarterly, sometimes they pay you monthly, sometimes they pay you annually. That coupon, if you buy below 25, you're actually making a higher yield than the coupon. If you buy something above 25, you're usually getting a lower yield. So that's a very basic understanding of how preferred works. Now, common is the ownership, right? You have the voting rights of the company. If you buy, and it's very difficult to, but if you were to have a controlling stake, 51% of the shares of a common, you would theoretically control the company. So you have the voting rights, and you're the residual interest of the company, which means that if anything happens to the company, most of the volatility is going to be seen in the common. But also, if a company files for bankruptcy, the common also gets wiped out first. So that is the 1 minute on a company's capital structure.
Thank you, Special. If no one has anything to add on to that, let's talk about risk management and how to help cut down losses. I think we should focus on protecting traders' accounts from losing all of their money and identifying and assessing the risk when we develop strategies to manage and minimize our accounts while also maximizing our returns. So if anybody has any tips and pointers for risk management, you can start talking now.
From the trading perspective, like, I don't know if any of you guys know Pete Doom, but he's been a friend of mine for a long time, and he's been a mentor to me as a trader for a long time. And probably the best advice I ever heard him in terms of phrasing risk management is he said, if it's too much, too fast, then take profits. And that sounds pretty simple, but just that concept of, like, if you think a stock is worth $500, let's say, and the stock is trading at 100 when you buy it, right? Which is going to be a rare case. It's very rare that you're going to get that great of an entry point on the true value of an equity. But let's just say you bought a stock at $100 that you think is worth $500. And let's say that stock goes to $500 in like 2 months. Well, in that case, you 5x your position in 2 months. That's too much too fast. At least on the big boards it is. And this isn't really relevant to OTC because you see runners like that all the time. But on the big boards, in 2 months, you're 5xing from 100 to 500. That's too much too fast. And so that, like, just general principle is a pretty, like, intuitive and instinctive way. You don't need to use any technicals. You just need to use basic common sense and logic to realize, like, if something I own is increasing in value without good reasons, right? Like, if your company's signing all these major deals and then, you know, multiplying their market cap over and over again, yeah, that's different. But if price action is sending the stock that high, too much too fast, take profits and you'll be better for it in the long run.
Can I take this, guys? Can I take this for a new trader? Because you guys are very seasoned traders and your advice is fantastic. But to new traders, the one piece of advice I would give for de-risking and kind of like Aaron was saying, saving them from losing money is before you go into any position, I don't care if it's the best stock in the world is, go in there with a plan. Figure out where your entry is and figure out where your exit's going to be and have a stop loss set. A lot of people frown upon a stop loss because they're like, oh no, you do whatever. But I think a stop loss has saved me personally from losing an immense amount of money. And how does that work for me personally is, with the stock, depending on the float, I go in there between a 2 to 5% stop loss, depending on the float. I adjust it for the float. If it's a lower float, I give it more of a kind of a rubber band to be able to go a little bit lower because it might bounce. But with the stock with a higher float, I give it a thinner leeway. So, like, I don't want to give a stock with $1 billion float a 5% stop loss because that could drop. That could be a bigger drop versus a lower float. Also, when exiting, have the same percent in your mind. When I first started, I picked a number. I was told, like, hey, pick a number in your head and use that as your kind of your profit taking number. So for me, that number was 7%. When I would hit 7% in the stock, going up on the way up, and I saw it would keep going up, I would first pull out my initial capital, and then the rest, which would be quote unquote your free shares or your profits or whatever. I'd watch that, watch my indicators, watch the chart, watch the volume, all the good stuff, right? With new traders, you'll learn all that good stuff on your way to your to your peak. I would use all those to scale out the rest of my shares. Right. Just have a plan and it'll protect you.
Right. Yeah. I agree with what everybody's saying, but I just want to say up here it says investing for beginners.
Yeah, so Robert, if I want to just dumb it down, I have a simple technique for all the new traders. If you guys can hear me, if you don't have a $25,000 account, like if you're under a PDT, whatever, load up Power Hour if you can. Even especially going into the weekend, CPI data tomorrow and then Friday. Load up Friday Power Hour if you can. Other than that, price target upgrades, I scalp really fast. 4% pops, I'm out 60%. 7%, I'm out 70%, and then the rest I'm out after 10%. After I take my profits, I delete it from my watch list because I know I'll have some FOMO to probably jump back in.
So you're basically you're planning the trade and then you're trading the plan.
If I'm scalping, and then I do have an exit like Ryan said, and then finally watch who has what. Like I literally know I'm gonna say through which ticker they have. Like Alex, Zach, I know all these guys' ticker what they have, and I know pretty much when they're gonna post it. Not saying like I'm watching these guys like that, but I'm watching the discourse. I'm watching FinTwit. I have an Excel sheet with like I'm gonna say 27 pages going all the way back from last year. So that's how I trade. Everybody has their own strategy. Alex, you could take over.
So everyone really covered everything of what I was gonna say, but I think you can combine it as a whole. When I say that you're looking at a company that you want to invest into or even swing trade, you need to look at it fundamentally as a company, and then know there's a big question when people said we're talking about CCIV and how not only myself but many others were saying that it's moving really fast right now, and it seems like there will be a pullback shortly. People are like, why are you saying that? Aren't you a long-term investor? And I'm like, yeah, of course I am. I like Lucid. But in the same way, you need to know when to trim a little bit. When you come into a long-term investment, you can always lock in your mind mentally what the amount of shares you are not going to pull out. So let's say 1,500 shares is the amount of shares that you do not want to sell whatsoever. But you are also trying to make some initial profits. So you either double it or, I don't know, you could double it. So you say 3,000. So you ride it up. And as it continues to spike or go over this 30 to 40% spike over the last month or so, you can slowly start to scalp away at 10%, 20%, 25%, and then to the point where it is your core investment, you'll be fine. And you just made a good amount of cash while it was going up. But in the exact same manner, when it comes to swing trading and day trading, when you're going to a situation where you're these are a lot of people that follow me, not all of you are day traders, and you're not going to be able to look at your phones every single minute, every single day. But the best thing that you heard Ryan say is a trailing stop order. When you are going to an investment, a day trade or a swing trade, have a trailing stop order. Don't put it at 1%, 2%. You're going to need to allow it to move and grow overall, especially if it's a low cap. If you see that it's in a potential breakout soon, if it's a bullish ascending triangle, or if it's doing a symmetrical triangle, but there's an influx of volume, you need to have these trailing stop orders to kind of allow your trade, your target to grow. And then once it goes up, it will, you said it, let's say 10%. It goes up, let's say, this is a low float. It spikes up 80% within a week. I don't know what the catalyst is going to be, but it breaks. And it goes up 80%. While you're not even looking, you have that set limit order where you will stop and sell all your shares. So it goes up 80%. It pulls back 10%, and you just sold all your shares for 7% of a profit, and you weren't even watching it. These kind of tools will help you manage your risk and help you make money overall, and you don't even need to look at it.
So just a couple. Yeah, go ahead, Scott.
No, go for it.
So a couple of things. Some great points made here. I tend to always keep, if you read Seth Klarman's book, Margin and Safety, I always tend to just have cash. And I think that, if you can invest with 50% of your cash, 80% of your cash, if you're highly convicted, you're always going to have some cash. Let's say you're investing in a handful of opportunities and you see something, right, that you have to get your hands on because they're reporting earnings tomorrow, and you did the work and you realize that it's going to be an idiosyncratic or asymmetric return, something you like. You don't want to have to sell out of a position. Or another scenario, if you're buying a position and you're wrong and you're still convicted and it goes down 20% and you don't have a stop loss, sometimes, if it's a durable company, it's not a meme stock, but it has a real valuation for it. It's a growing business, like buying Amazon or Facebook during the pandemic, the worst of the pandemic in April. You need that cash to double down and to make a compelling return. And it's hard to know exactly when. You can't time it perfectly. But for example, when growth stocks sold off very dramatically, somewhere down 60-70% in February, I had some value names that hadn't moved at all, and I had some cash, and I took that cash, and I bought those names, and then I recently sold them. But some of those names were up, like Upstart was up 60, 70%. If I didn't have cash, I wouldn't have been able to buy it. So one, just always having some cash is just the way I like to operate. And then two, if you have a name and you want to hold it for 3-5 years, you don't want to sell it for tax purposes, because we're all talking about investing and trading, but we have to touch on tax, and maybe that's another discussion.
I think what Special's trying to say, I think, and Special, correct me if I'm wrong, but regardless of if you are trading or investing, there's value in cash, because the reason that people maintain the reason people maintain cash, like, look, think about it this way. Let's say you're a long-term investor who's just buying stocks like Square, Disney, financials, cyclicals. Let's say that's your entire portfolio, just hypothetically. Even in that case, it is fundamentally better to have cash, because even those names will correct to levels that are appropriate for you to add more to your position. So even as a long-term investor, there's value in cash, because as a long-term investor, your goal is to build positions at value prices. That is the purpose of long-term investing. And so having cash to access those names on inevitable corrections, right? Because those names all crash when the market crashes, right? So having cash in those situations allows you to build positions. So I actually disagree. I think cash is important regardless.
Yeah, and also it's not a new topic. I mean, this has been discussed since the 1930s. I mean, I'm replacing bonds with cash because bonds are really expensive right now. What financial advisors used to tell you was to have a 60-40 portfolio or 70-30, depending on your age, have some allocation to bonds. But with bonds, after a 30-year bull market being very, 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 very expensive, with the 10-year, below 2%, would you rather put your money in something that yields 2%, where you can lose 5 to 10% of your money because it can fall when interest rates rise, or would you rather put your money in cash? This is not something I came up with. I mean, Klarman wrote about this 15 years ago, and this Graham and Dodge talked about this, and this is not. You can be a trader or investor. I would say 99% of investors don't have portfolios that are all stocks. They have some bonds, and I'm replacing bonds with cash because I don't think bonds are attractive at all.
Yeah, I'm not in bonds at all either, and so I agree with that.
And I want to I'm on what's Special and Stock Talk. I agree with them in every shape or form. The number one thing is that cash is your risk management, but you can utilize it in swing trade aspects with your long-term investments. If you believe there's a major pullback and you just lost a little bit of your long-term profits, you can add upon, once you see consolidation and that this is sold, you buy more of your shares to increase your holdings. And then once it returns up, guess what? You just made more money than what you lost. And then you can pull back. You can always mix the way that you are. Never limit yourself that you're just a long-term investor, that you're just a day trader. You can always be both. You could be a long-term investor and do swing trades alongside of it. And you can always let your money work for you. That's what that extra cash is for. So you protect yourself, and then you allow yourself to gain that money back, and then some. That's exactly what you do.
Alec, I would agree with that, because I mean, this is OPT Flow Rider. I trade predominantly options, and I trade those alongside my long-term portfolio, from covered calls, covered puts, to just straight calls or straight puts. And I'll take those profits from those trades and roll it into my long-term. And basically over the period of time, like, I got into CCIV pre the whole chaos thing. And luckily I was playing calls on the way up. And I'm very happy to say my entire CCIV long-term hold risk-free, because I've made so much money selling covered calls and puts and straight calls against it that CCIV could literally go to zero tomorrow morning. It won't, but it could, and I'd still be net neutral on those trades. So I think that whole trading mentality, or you've got to be a long-term investor, I think that's very limiting to, the community, because also a lot of the community is newer, and they don't necessarily have the funds to go and throw $15,000 at each SPAC and sit there for 5 years and hope this is the one.
No, I just wanted to say, I think that, we hear a lot of talk on FinTwit about like the size of your account being a reason that you either can't risk manage or a reason that you can't, make appropriate allocations. And I think regardless of the size of your account, like if you're running a $10,000 account and you're trying to make $1 million trade, it's more likely that your $10,000 account is going to turn into a $1,000 account before you do that. And so, like, I think that there's this perception that, with smaller accounts, you have to take more concentrated approaches, or you have to take more, you have to like throw risk management out the window because you're swinging for a home run. And like depending on your risk tolerance, like if that $10,000 you have in your trading account is 1% of your net worth, or less than that, and it's just like play money for you, if it's like going to playing blackjack at a casino for you, then of course don't risk manage and just hyper concentrate your positions, play short-term expiry options. If that's your cup of tea, do that. But allocating your portfolio into different risk assessment classes is an age-old strategy, and it's what funds and institutions do as well. And so there's no harm, like multiple people here have said, in both trading and investing. I do that. I have an IRA that I manage from a value perspective purely, and I value it from what I see. Like I don't hold things in there that I don't see as having A, price stability, and B, potential to grow. But then my trading account, I manage drastically differently. I keep it high cash. I constantly pursue opportunities. I, will play options. I'll do things that I don't do on my long-term account. So I think that this stigma that you cannot do both is like super misinformed, and it's really widespread too. So I would be careful to listen to that narrative that you cannot be both a trader and investor. It's not true at all.
Right.
Absolutely.
Yeah, and options that you mentioned, I think it's a little more advanced for this group. So, or at least today, but we definitely are going to talk about that at a later date. In Options Florida, you're definitely going to be a speaker for that, and also PBJ rights puts. Y'all are both going to be involved.
Yeah, option flow, OPT flow, as well as PBJ. I also there's one of my good friends and good peers, King Blemmy, in here. He is an option artist with the SPY. That man can do options like no one's business. So I definitely think that if we're going to do options, have OPT Flow, PBJ, and King Blemmy bring
I
it
think
in.
Unusual Whales is another great speaker for that topic. He's very knowledgeable on that topic. He's a buddy of mine as well. I've talked to him.
He posts a lot.
Several times, and Wales is very, very knowledgeable when it comes to options flow. He's also very knowledgeable when it comes to how to risk manage your options trade. So he's another great speaker.
Let's go. So, okay, I wanted to give an example from, like I said, I started trading at the end of 2019, so I'm still learning. But I wanted to talk about trailing stop losses one more time, just because I think that's very important. I'm going to give an example, like a simplified example. So if y'all want to correct me, you can. I'm just going to try to get through this as like easy as I can. So let's say I bought a stock for $10. When I woke up, I set my stop loss at 10%. So I go downstairs, go make breakfast, do my hair, get ready for the day, and then I go back later and I check my phone to see what the stock did. Well, while I was gone, it rose from $10 all the way up to $100, and then it dropped all the way back down to $9, where my stop loss was set at the 10% mark, and it closed me out of the stock. So realistically, I just lost out on a $90 gain, correct? So that sucks, but if I were to have set a trailing stop loss, so this is where this is very important and comes into play. I set my trailing stop loss at 10%. As the stock rises, the stop loss would continue to hang behind the moving price to catch whatever gains I had locked in below the current price. Since the stock rose all the way up to $100 and reversed back down, as soon as the price hit $90, I would be closed out at $90, which is my 10%.
Or if you're new, you can use a bracket order. In a bracket order, you do take profit and stop loss all at once.
What is a bracket order?
So like for example, when you buy a stock, you can place a bracket order. For example, let's say you bought the stock at $10. And you can look at the level 2, right? You can see there's a huge sell order, $15. So you can put the sell order for take profit at $14.99, just a cent below that, and stop and look at level 2 again. You can see a huge support. Let's see $9. So you place a sell order at $8.99, just below that.
Right below it.
Yeah. Instead of having multiple orders of taking profit and stop loss, you can use all at once. And once they sell, your order gets cancelled. Because if you have a take profit and stop loss and you're day trading it, if you don't cancel it, you might end up opening a short position. A lot of people don't cancel that. Let's see, you bought the stock at $10. You have a sell order at $15 and the stop loss at $9. And if the stock goes $15, you sell, but you haven't canceled the sell order at $9, it might get filled and you might open a short position.
Okay. Yeah, I think my Webull has that option.
Yeah, so if you're new, bracket order to your best friend, especially if you're day trading. If you're long-term investing, it might be a different thing.
Okay, if y'all heard that, bracket. That's our best friend.
I tend to use brackets a lot, especially if I'm day trading. I like to use the bracket mentality, and Webull is very good for that. Like right on the board, you see the 2 boxes on the bottom, take profit and stop loss, and you can set it up in one shot. And the good thing about Webull is, just like Gerg was saying, it cancels it for you, so you don't end up shorting it and then getting screwed a little bit later. But it's a great suggestion. That slipped my mind. Thank you, Gerg.
Yeah, bracket. Yeah, what Gerg said is I don't really need to add anything to that. If you're day trading, definitely look into bracket orders. But yeah, as Aaron said, trailing stops, they're essentially vehicles that can trade for you, basically, because they're just going to follow the price action, and then it'll basically define your risk from the quote-unquote top. And so both those things are worth looking into for newbies.
Are you guys using any stop losses for like your long-term positions at all?
For me,
I don't have any stop loss on my pair,
Same. If I have very, very high conviction and I plan to hold something for a year or 2 years, I don't care if it goes on 5-10% in the short term, right? For example, Palantir is my biggest position. I wanted to go down so I can buy more at cheaper price. So
why would you sell it?
Yeah, 100%.
Exactly.
Yeah, I feel the same way with things like Square, Teladoc. I have a few very high conviction names in my IRA that I will not sell. I'll only buy more, and so those names, no, I don't even think about stop losses. I mean, I guess I have mental stop losses if the market crashes, or something. But I mean, in those cases, I don't sell those positions anyway. So, but yeah, you can. I think mental stop losses. Some people preach about that. That's fine if you've been trading for a long time, and there are times when I'll do that just because literally trading is all I do, so I'm doing it every day, all day. So if you're somebody who has that much time to allocate to it, it's easier to say, I'll set a mental stop loss because you can watch your equities the entire time. But most people don't have the privilege of doing that. So for those people, these kind of tools are really effective to be able to go eat lunch and not lose a trade because you're fucking eating lunch.
If you're staying up till 4 a.m. and you can't sleep and you're worried about a material change in your net worth to the point where it is hurting your health, I'll tell you a personal story. I have actually some real health issues because of the way I treated my body and the way I treated my mind early on in my career. Back in the day in this industry, people would work you to the ground. They didn't care about your health, your weight, your mental health. And all those things are extremely important. Getting rest, getting enough sleep, eating 3 square meals, being healthy, having a social life, having a family. You can't let the market take over, because when it goes against you, no one's going to remember it, right? No one's going to remember that, your body's not going to say, oh, well, okay, well, the market didn't work out that way. So here's everything that you forgot to pay attention to. Here's your health back. Your wife's not going to say, oh, here's all the love back that that we didn't get to spend time together for the last year. So put it in perspective, and on a more relevant note, if you can't walk away from your desk for 5 minutes, or you can't take a 10-minute break to look at your phone, you're probably taking too much risk. Unless you're extremely convicted, and this is like a once in a quarter thing, and a company's reporting earnings. If you feel like that every single day, then you need to take a break.
One more thing is, if you're long investing, if you have a stop loss, flash crashes might trigger a sell order. So
also, on that same point, when you have institutional involvement in an equity, or you have algo involvement in an equity that you're trading, you can get knifes that will recover within 5 minutes. Like, on some of these SPAC and small cap names, you will see knifes that will lead to a -6 or 7% right off the rip at open, and then 5 minutes later the stock will be rallying plus 11%. So like even this week during all this volume influx, I saw 15 to 25% swings in the value of the stock from -10% to plus 15% in 15 or 20 minutes. So if you're going to panic every time you see intraday price action and you go, I should have set a stop loss, or I shouldn't have set a stop loss, like, don't be that guy or girl. So just realize that stop losses will sell your stock if they hit, and be okay with that, because it's just a tool of risk management. And if you don't want to use them, then don't use them. I know great traders who never set stop losses too. It's not a thing that you have to do. It's just another tool that helps with risk management. So, define your own strategy and be okay with it.
Yeah, and just to add to that too, like I don't use stop losses. I'm mostly not long-term investing. But just one thing that always stuck with me: if you're not ready for the consequence, it's kind of like a condom, right? If you're not ready for it, it's already too late by the time you had it in place. So if you're not ready to take that hit, just make sure you have that condom or stop loss in place. And thanks for having me up, Aaron.
Just one more note, stop loss orders will not execute in extended sessions, so you have to use limit orders. So that's just something to keep in mind. That my parents had an investment about 10 years ago that gapped down on them overnight, and they had no idea that their stop loss order wouldn't execute, and they took a really hard hit on it. So definitely keep that in mind.
That's a good thing, right? Because after it's so illiquid, you might see 10-50% drops, but by open, they might go back to the mean. That's a good thing. If you do take profit, it would be a good thing, because some idiot might do market order at after hours, and if you look at the bid and ask, it might go up 10-30%. Sometimes you see that in small floats. Like you see some guy bought 100 shares for 50% premium, and when the stock opens, it's back to the mean. So
another thing, I think Mello, great point to make with regard to after hours. None of your brokers set orders, or none of them will fill. You can set limit orders during the regular session and then mark them to be applicable. So that is something you can do. Most brokerages have that option. So when you're placing a limit order, you'll see an option that will say, allow this order to execute during the extended session. And so that's something to keep in mind. But also just a general point about extended sessions, and this is for after hours or pre-market. If you are a new trader and you are trying to add or sell positions in the extended sessions, please realize that the liquidity is nowhere near what it is during the regular session. So you're going to have much bigger gaps between the bids and the ask. I very often see this in pre-market. Like, I'm a very active pre-market scalper. So what I'll often do in pre-market is, if I see something run too hard, too fast on an initial reaction, I'll sell into that strength, and then I'll buy it when the volume influx cools down. So that's a really easy way to make money, by the way. If anybody's looking to make a quick 5-10% in the mornings easily, pre-market scalping is a consistent way that I've generated income for years. But again, on that point, be careful about the bid-ask spread in these situations. Also, be careful to look at an equity in pre-market and say, oh, it's up 10% or it's up 15%, but then it's up on 900 volume. So look at the volume and realize that a stock being up 10% on 900 volume means absolutely jack shit. It means nothing. So don't be the guy that's chasing that, saying, oh, I'll buy this 10% higher. It looks like it's going to run because some kid in Singapore placed an order for 900 shares. Like, that means nothing. So be really, really vigilant in extended sessions, because extended sessions really, honestly, are built for more experienced traders to take money from new traders. Because of the lack of liquidity, and because of the the difference between the bid-ask spreads on some of these, especially these smaller names. I mean, you will see crazy bid-ask spreads that will blow your mind. Sometimes they'll be like $1 apart. And so be very careful and just be vigilant about the volume, the trend of volume, what time it is where you are, and be very careful about ads and sells during those times. So I just want to say that.